Well, hello agents, hello everyone. So today I'm just going to jump into a little tutorial on free withdrawal provisions inside of the deferred annuity contract where you can get access based on the contract language. So let's jump into this. This is the deferred annuity, fixed annuities really, lump sum withdrawal options, contractually exempt from surrender charges. So let's take a look at some of these options and walk through how they will work. So first thing we have is the interest-only withdrawal. The interest-only withdrawal is basically can be done in a lump sum, right? And it usually based on the current accumulation value earned since the last anniversary. So if you have $3,000 of interest, you can take it out, $3,000 of interest since the last anniversary. Pretty simple, right? The lump sum withdrawal provision. There's also the systematic withdrawals, which means you can take a monthly, quarterly, annually based on the contract. And that's usually also based on the current accumulation value. So whenever you trigger it, even if it's 6 months into the third year and you trigger that, it'll be based on the value of the time you trigger it. Again, those are usually taken monthly or annually. Next is the cumulative interest withdrawal. And that means the ability to withdraw all interest earned since the policy issued. So if it's a 10-year policy and it's been 5 years since it's issued, you can take all 5 years of interest out. So at 6%, that's like 33% after 5 years with the compounding, and it's a lump sum you could take out. So that's a cumulative interest withdrawal. I really like those. They're great for people who are maybe under 59 and a half and want to wait till they're 59 and a half and take all the interest earned in that account. So cumulative interest withdrawal is different than just the simple interest withdrawals that are based on the previous contract anniversary language like that. Then there's the lump sum based on a percentage. So commonly seen as the 10% free withdrawal provision. You know, you can take, however, I have seen them up to where you have 15%. I've seen them as a lot hard as 20, but most commonly used is the 10%. Also, you know, they might be 5%, limited to 5%. So that's how that one works. And the percentage might also be limited to whatever the interest rate is. So that's a kind of an interest only, but they call it a percentage. So if your interest rate's 5, you can take 5%. Some of them have a 5.5% interest rate, but you can still only take 5%. So that's the percentage. So you can take a percentage. And that's often based on the current accumulation value as well. So whatever the current value is worth at the time. However, it can be limited to the value of the last anniversary. And it can also be limited to, say, the initial premium. So you put $100,000 in, you can take 10% of the $100,000 at any time. So even if the contract, you take 10% out and it goes to $92,000, you can still take $10,000 because it's based on the initial. So that can be more than the 10%. So it's 10% of the initial premium. So each one can be a little different. Those are the lump sum based on premiums. And it also can have a cumulative feature in these. So if not used in a previous year, the 10% can accumulate to 20%. Oh, you didn't take it last year. Well, we'll give it to you this year at 20%. You take the 20%, resets back to 10%, basically getting to use the unused amount in the past year. And that's usually capped out like at 20%, but I've seen them as high as 50%, but they cap out. Like you can't not take 15 years and get 150%, right? It doesn't even make sense. So yeah, they usually cap those out. Next would be the required minimum distribution, or the RMD withdrawal, often referred to as RMD-friendly products. This is the ability to withdraw the required minimum distribution, the RMD, without penalty, even if the RMD exceeds the free withdrawal provision. So an RMD-friendly contract will allow you to take the RMD even if it exceeds, say, the free withdrawal. Let's say interest rate is only 3%, your RMD is 3.5%, and the withdrawal is 3% maximum. They'll allow you to take 3.5%. Now, not all companies do that. If the RMD exceeds the free withdrawal, they'll still charge you on that. Those are non-RMD friendly contracts. So just be aware of that. Each one can be a little different, and you can't combine the two. So if you're within the surrender period, you can't say take the RMD of 4% and a 10% free withdrawal provision and say, hey, I want my 10% too. That would equal 14% and violate the free withdrawal provision. But you can take the remaining 6% or whatever is up to that 10% of the free withdrawal provision. So that's how that would work in the RMD. There's some limitations in these too, and all of these can be limited by the contract, right? The insurance contract language. So some of the limitations you might see is, hey, the minimum withdrawal amount you can take is $100 to $1,000. So If your monthly withdrawal is only $50 on a systematic, you can't do it. You'd have to switch to a quarterly to get above the minimum the company will allow out. And it's just to keep excess work for the company or doing work that they find not profitable, right? It also might limit the amount of times you can access it. So you can't go like 6 times in a year and say, I want 2%, 2%, and 1%. So they'll limit it to maybe say 2%, 2 times a year on the withdrawals, how many you can take on those. So that's one of the limitations on the amount of times you can access the contract per contract year. And there's also this certain things where it might not be in the contract, but the company will allow it by current company practice. So the contract might not allow any withdrawals at all, but the company allows RMGs by current company practice. So this is where the contract is not clear or does not allow withdrawals, but the carrier is allowing the feature currently. And this can change based on the company at will. So you want to be careful on by company practice or by current company practice and realize that can change. So not really advisable for RMDs. For the free withdrawal, hey, you just stop it. But RMDs, you need to take those every year. So if the company at will decides, hey, no, we're not allowing any more withdrawals, you could incur a surrender charge on that even RMD or whatever withdrawal if they change the current company practice. And also, companies' illustrations do a pretty terrible job for the most part. Some are really good at showing the withdrawals. If they even allow, like their software even allows, I know some that I really like don't even show it. They haven't put the time or money into being able to show withdrawals at all. So you can only do an accumulation withdrawal. And this is why the contract language is the best place to find the free withdrawal provision features, because you could show it on the illustration, but that it might still trigger a surrender charge, and you don't want to trigger a surrender charge. So you want to make sure you look at the contract for all those features to make sure you know what you're getting. And if you're buying a contract and you want to know, there's the specimen or sample contracts you can look at that will explain this. Sometimes the brochures are pretty good at that too. Be aware, if a full surrender or more than the free amount is withdrawn, I've seen this in the past where some carriers will impose a surrender charge on the entire amount, even if it had a 10%. So if you cash out the whole policy, they'll still not allow the 10% without the penalty. Some will. They'll just say, hey, the 10% doesn't have the surrender charge and the rest does. So again, just be aware of that. And each company and each contract will be different in that case. And of course, withdrawals may be subject to, and usually are subject to, ordinary income tax. And if made prior to age 59 and a half, can have the 10% excise tax as well. So your 6% can come 540 really quick if you're under 59 and a half. And you take the withdrawal and there's a charge, on that, your penalty. So here's some just disclosures going through, claims are all the companies are only as good as their ability to pay all claims, right? Not available in all jurisdictions. So yeah, that's the end of my presentation. So just a real quick review of withdrawals. So they're not tied up forever. It depends on the contract. You can get as much as, cumulative withdrawals. Again, if you don't take it, I really like those cumulative withdrawals. Those are great, or at least the 10% free. And if you have qualified money, and that gives you the advantage if interest rates take off, you can move around and you can use these free withdrawals to maximize your yield. So anyway, I hope you all having a great week. We're going to be closed for Labor Day. I hope you all have a great Labor Day weekend, and we'll talk at you next time. Thanks for watching. Bye-bye. Oh, and follow me on LinkedIn and YouTube for the most up-to-date information. Take care. Bye-bye.